Hello and welcome to this edition of Who Moved the Market. I'm Surabhi Upadhyay. Well, it may not have moved the market, but it is one stock that has definitely captivated the market's attention today. I am talking about the spectacular near 15% rise on a mid-sized IT company, Mastek. So what happened? Well, Mastek came out with numbers, and they were solid numbers in an environment where the industry giants, Infosys and TCS, have been struggling. So what's the story? Is there something that we can sort of read through, how to join the dots? Well, to help us do all of that and more, we have Reema back on Who Moved the Market with us. Reema, thank you for joining in. You've got the hottest sector. What do we say? So you are the frequent, appearance on the show. But yes, tell us, what have you made of it? This kind of absolute, frenzy around Mastek today.
Well, I think it's just come in as a surprise. They're a very strong set of numbers and across the board. So it's a beat on all counts, and it came in out of the blue. No one was anticipating a solid set of earnings from IT, right? Like your best case was that the companies deliver on expectations. Yeah. It's not such a bad performance. But this is actually a good growth quarter for the company.
So for 5% constant currency?
Yes.
I saw that number, my eyes popped. I was like, is this even real?
So I went and checked whether there were any acquisitions. So my first thing was like, did they do any acquisitions? Will there be any quarter-on-quarter boost, to the number? Because a 5% plus organic revenue growth is very, very strong given the environment that we're in. And so yes, this is an organic revenue growth, most of it at least. They did some acquisitions in the prior couple of quarters, but 5% plus is the organic revenue growth. It's almost approaching a 20% year-on-year revenue growth. Margins have also expanded. Margins are up, 50 basis points. So, compared to peers, this is a solid set of numbers on all fronts.
And I'm just struggling to understand this. Are they operating in an alternate world? But, on a more serious note, tell us more. I think you mentioned that Europe and UK, I think these are two important geographies for this company, right?
Yes. So UK and Europe is largely 60% of their overall revenues. This company was started because it was outsourcing a lot of the work from the UK government, as well as many of the public sector enterprises of the UK government, like NHS. Okay. So they were getting a lot of work from them. So UK was historically their strongest area. But then they decided... they decided to diversify. So in UK and Europe, they started catering to private sector as well, and now increasing...
Okay, we'll allow Reema to just catch her breath a little bit. I'll go over the numbers in the meantime. Again, to put things in context, there is a 5.3% constant currency revenue growth that the company has done. The EBITDA margin, as Reema pointed out, has expanded. Not too much, but still there is an expansion. 17.7% versus 17.2%. So it is a good 500 basis points up move in an environment where a lot of other companies, the bigger guys, they are struggling. So UK obviously is a very big market for them. Europe, you're saying they're getting, they're scaling up with clients.
So they're scaling up to more of the private sector clients in UK and Europe. And now increasingly, they've set their eyes on expanding in US as well. So US is right now about a quarter of their overall revenues, about 25-26% in overall revenues. They've got a new leadership in place there. I think Vijay Iyer has joined in to head the Americas market for the company. But UK and Europe is where the company predominantly focuses on. And right now, the problem is more with US. The Europe business has actually done pretty well, 10% quarter-on-quarter revenue growth. US has been very subdued.
But that's a smaller, I'm guessing that's a smaller business.
It's just 25-26% of their overall revenues, right? Okay. So it's not big to begin with. And I think that's something that has helped. The fact that they're not a US-centric company, it's largely UK and Europe. I think that's something that's worked in their favor this time.
Sure. Anything interesting from the management commentaries, some of the conference call highlights, anything that caught your eye?
I think the key takeaway is that the outlook is quite promising and rosy.
They said that?
So they said that we will grow faster than the industry, one. And two, they said that we're ending the year with margins of 17.8%. For Q4, it was, I think, about 17.43, thereabout. But their aspiration is high teens margin. Okay. High teens here should be read as 18-19%. Okay, so they are looking to expand their margin. At least that's the aspiration, or whether they achieve it or not. But at least they're not guiding down on the margin front. And even the other metrics, right? The order book has picked up 5% on a quarter-on-quarter basis. So that's a positive. Commentary, particularly on UK and Europe, they say, yes, the environment is volatile, but they seem to suggest that their core business is holding up. In US, as I said, again, it's a very small percentage, 26% of their overall revenue. There is some delay in decision making, but since Europe is the key geography for them, UK and Europe, their demand is, the environment is volatile, but their demand appears to be resilient.
It's really interesting, right? Because even Europe as a geography saw the acquisition of Credit Suisse, which is actually a far larger bank, and systemically it was a far more important institution. But it seems that even though that deal happened, in Europe at least, clients are not shirking away as much as they are in the US. And some of these finer points I think are very, very interesting from the Mastek numbers. Reema, tell us about valuations and anything else that kind of comes to mind on this breathtaking move, 15% move that we've seen today.
Well, remember Mastek is a small company, okay? Yeah. So you should not forget that.
Yeah.
Its market capitalization is about 5,500 crore. To put it in context, TCS's market capitalization is more than 11 lakh crore. Infy's market capitalization is more than 5 lakh crore. So it's 1/10 the size of Infosys and much smaller, okay, compared to a TCS. 5,500 compares with 11.5 lakh and about 5 lakh crore, right? Even in terms of the top line, it's a much smaller company. Yeah. So that's the extent of extrapolation you should do or should not do in this case.
Absolutely.
But when it comes to valuations, it's trading at more attractive valuations. So it would be close to 12 times prior to the numbers, while the other mid-cap IT companies, and some of them larger in size, were also up to 20 times, 25 times, some of them. So they have that valuation comfort, but a lot of it is now being caught up with the kind of rally. Also bear in mind the stock, like the rest of the IT companies, has fallen a bit. Now today it's trading at 1,800 rupees per share after the 14% up move. Its lifetime high, no, not lifetime, 52-week high was 2,960. So the stock is about 35-36% away from its 52-week high. So that headroom is also lending support.
Okay, so Mastek, as Reema tells us, is close to, I think, 12 times, and the rest of the...
I think now will be 15 times after the up move and, post the up move. But it's still cheaper. It's not an expensive... mid-cap IT company.
Compared to the others. Fair enough. Reema, totally take your point. This is not apple to oranges, and I'm not trying to extrapolate or read much into it. But, like it or not, after these numbers, people will watch out for commentary. HCL Tech is a very different company, but people will want to know if, at least in the non-US areas and some other parts, whether HCL Tech's commentary is as bearish, as bad as Infosys, or can it show some sparks, perhaps?
We'll have to wait by. Today, the press conference is scheduled at 5:30 p.m. to 6:30 p.m. So we're going to be glued in. At least I'm going to be glued in for the numbers and commentary. But in terms of the pure guidance, I think a guidance close to Infy will be digested by the street, right? Why should it be any different? Infy guided for 4 to 7%. Yes, Infy was 4 to 7%. HCL Tech, my consensus was 5 to 7%. So numbers in and around Infy, it should be, digested, as I said.
What's the Q4? I know Q4 is like in the rear view, but just because Infosys shocked us even on the Q4 number, that negative 3.2%, that's why I'm asking you. HCL Tech, I mean, generally speaking, top line for Q4, what are we expecting?
Minus 1 to 1.5%, but that's because, say HCL Tech gets most of its revenues from services, which is where Infy TCS play. But they also get a portion, about 25-30% of their revenues from products, okay? Where Infy and TCS do not play. Now, in Q3, their products business did phenomenally well. It's seasonally strong, and it had an exceptionally strong quarter. It shot up. But that will come down in Q4, right? It'll normalize. And that normalization itself will result in a muted Q4. So there was that base effect playing out in the case of HCL Tech. So the street was working with a minus 1 to 1.5%. So that was in the price. In the case of Infy, it was not expected to be a negative growth, right? In HCL, anyway, we were expecting, a negative growth because of this normalization of their products business.
I don't think that the IT services earnings season has been this exciting, in the recent past, the last couple of years. It's usually a very routine affair where companies more or less come and deliver along expected lines. But speaking of earnings, just to end things off, another mid-cap company is reporting Cyient. What's the expectation there?
Well, Cyient is expected to have a good quarter. Also because they get revenues from the aerospace business. And that's doing very well. Their business got hit during COVID. Airline companies had stalled projects due to COVID. But now things are ramping up very quickly on that front. So because of their exposure to aerospace, railways, pockets of travel, this company is doing pretty well. So the growth rate, according to the company, at least in the Q3 conference call, they said Q4 revenue growth will be better than Q3. Organic, constant currency, so like to like, should be better. Do they maintain that? So that's going to be point number one. Two, Cyient also gives you an annual guidance. So we will watch for the FY24 annual guidance in the case of Cyient, but they also set out a long-term aspiration sometime back. They said in FY24, we will achieve a $1 billion run rate and achieve an EPS of 60 rupees. Is there any change to this because of things are getting tougher? That's something we'll watch.
Okay, so promises to be an action-packed evening for Reema, and of course a lot of us will be watching very closely as well, because if there's anything that comes close to the IPL in terms of action and excitement, it has to be IT earnings this time around. Thank you very much, Reema, for making sense of all the numbers and demystifying this massive move on Mastek today. Well, there you have it, the latest from IT earnings. And on that note, we're going to take your leave, but to keep your feedback coming, we'll see you again with another theme tomorrow.